Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Mike Richmond, Managing Director at middle market investment bank, the DAK Group, about the options sellers have with respect to potential buyers of their companies.
Mike, thanks very much for spending some time with us. I guess maybe to start out, if you could just give us a little bit of background on yourself in terms of where you come from and when you joined the DAK Group and all that kind of good stuff.
Well, thank you, Paul. I am a managing director at the DAK Group. In terms of my background, before joining DAK, I worked for over 20 years in senior positions in commercial banking, all in the middle market. I spent much of that time in the leverage finance group. And in this area, my clients were both financial and strategic buyers, and I arranged for financing of leverage buyout transactions. When I joined the DAK Group about 6 years ago, in essence, I switched sides, and now I'm working for the sellers. But I have to say, having worked for both sides of the table, I got some valuable insights as to how the sellers think, what they value, and what their concerns are. I also gained some insights in how to finance some challenging leveraged transactions.
Okay, and you know, we're talking today about the difference between sort of strategic buyers and financial buyers. Obviously, there's a pretty fundamental distinction there that has a lot of ramifications for both sides of the transaction. Could you maybe just to start out, could you sort of define what we mean by those terms and how those two types of buyers may differ for a seller?
Sure. First, with financial buyers, they are also known as PE, private equity, or LBO, leverage buyout funds, and they're in the business of their business is buying other companies. They raise a fund, which generally has a life of about 7 years, and their goal is to deploy these funds by buying other companies. They then try to improve the underlying performance. Generally, in about 5 to 7 years, they want to liquefy their investment. And they'll do this either by selling the company again, or if the company is big enough, perhaps through an IPO, an initial public offering. A financial buyer's key motivation is return on investment, ROI. They look to maximize their returns through the use of leverage, hence the term leverage buyout. They'll look to fund a buyout with anywhere from, say, as little as 20% to maybe 40% equity, and they'll finance the remainder with debt, and often the seller gets paid with some notes and or percentage of the new company with equity. A strategic buyer, as the name implies, is an acquirer who wants to make an acquisition for a strategic reason. A strategic buyer looks for businesses that could be integrated within their own core business or one that will complement its core business. They're looking for synergies that the combined companies can put together to reduce costs and ultimately, of course, improve profitability. It's a more longer-term buy and hold strategy. A strategic buyer may be in the same or related business, but not necessarily so. And they certainly don't have to be a competitor. A strategic buyer could be seeking sales and earnings growth, but they also may be looking for product, or customer or geographic diversification.
Yeah, and I guess maybe to add to the strategic buyer part, and this is just something I'd come across recently, a specific example of this. I was interviewing the CEO of a food brand and a middle market, food brand, and he was discussing this with me, the idea of, and I asked him sort of, where do you go from here? And he said, oh no, a financial buyer is never going to be in my horizon because the economics just don't work. What I'm going to do is, or what's going to happen with me is there's going to be a strategic buyer that comes in who very well may do it strictly for defensive reasons, in the sense that this gentleman had a food brand, sort of Mexican food brand that had turned out to be fairly popular. And his point was that the valuation with respect to his company really didn't rely on financial metrics. It relied on either the opportunity for a large food company to come in to exploit his brand, or maybe even more importantly, to get rid of the annoyance of a competitor. So basically taking over that brand as a defensive move, if nothing else. I mean, that sort of fits into the definition that you're talking about, right?
Oh, absolutely, Paul. And I think it's you said something very important here that I think our listeners should focus on, and that to maximize the value of a transaction, it's very important to get a buyer to focus on things beyond the numbers. The numbers get you a multiple, and you're at that point. But the key is to focus beyond the just the earnings.
Right, which sort of leads into the broader question of, depending on sort of each type of buyer, strategic or financial. I mean, they're going to probably be looking at different things for each acquisition. In terms of, certainly, I guess there's probably a continuum between the two, in the sense in the middle there are probably basic things. Make sure that there's a good management team, operationally things are sound, that kind of stuff. Although maybe not. Now that I think about it, I'm thinking of the Mexican food brand. That they just may want the brand, but I guess that raises the question in terms of strategic versus financial. What are those kind of buyers looking for? If you're talking to a seller and saying, okay, you want to sell your business in 2 years, depending on which type of buyer is available, here's what they're going to be looking for. What would you tell them?
Great question. And a strategic buyer, let's take a step back. A strategic buyer, in the case of your Mexican food company, is typically much bigger than the target company and has the financial resources to move quickly and quite frankly, pay with cash. They typically don't need financing. And because they don't have the strategy of selling the company in 5 or 7 years, there's no pressure to turn the company very quickly, and they could look for a long-term strategy. A strategic buyer may be less sensitive to certain limitations that a company has. For example, it really depends on what the strategic buyer is looking for. If they're looking for geographic diversification, then they want to enter your markets and maybe rebrand that Mexican market, that Mexican company, as you talked about. If a company has supplier concentrations or a seller is maxed out on the capacity of its facility, these would be challenges to a financial buyer, but not necessarily to a strategic buyer. A strategic buyer that has excess capacity, for example, may be looking for a company that can fill its capacity, or it may look for other synergies that can be added by adding a complementary business. So typically, as you alluded to earlier, a strategic buyer can and will typically pay more for a business than a financial buyer. And for that reason, over the last 5 years, about 80% of our transactions have been sales to strategic buyers. However, there are instances where selling to a financial buyer would make more sense. And that is to the extent that a seller wants to take some money off the table now, but believes that there remains strong, say, untapped opportunities for growth, a financial buyer may make more sense. because financial buyers typically want a seller to have some skin in the game.
Right.
And often they actually will require a seller to co-invest along with them, requiring to a seller to hold a certain percentage of the transaction value in stock. So here, in a case where a seller may sell a majority stake, he holds a minority stake, and this gives the seller some financial security now, with an opportunity to get the second bite of the apple down the road.
Right.
And along these lines, a financial buyer might be able to provide capital or other resources to help a company grow to levels and achieve sales and profitability growth that they couldn't do on their own. And financial buyers, quite frankly, often want the selling management to remain with the company during a transition period. So a seller who is maybe nearing retirement but really feels he's got a couple of good years left could stay in the business for a period of time without the full burden of running the business. So for some sellers, it's really the best of all worlds. They could take some money off the table now, stay involved with the business, and down the road getting a second bite of the apple, and sometimes that second bite of the apple could be pretty big.
There's actually kind of a hybrid of a strategic and a financial. And the only reason I bring that up is that there are a few firms that I know of that are, I guess I'd call them family wealth funds, but who are I think of something like the PRESIDENT Group, for instance, who are not, they're private equity groups, but they don't have the 5 to 7 year horizon. You know what I mean? In the sense that, they're a private equity firm that also is a buy and hold firm, so they can afford to be strategic and financial at the same time, which is, then that's an interesting. Have you seen a lot of that? I mean, I would think family wealth funds would be kind of like that, in the sense that they've got a 40-year horizon rather than a 5 to 7 year horizon. I mean, do you see a lot of that, or is that kind of unique in your business?
No, we're seeing more and more of the family funds playing a role as buyers, and I will say that there are financial buyers that have a strategic component to their acquisition. For example, if they own what they call a platform company, they have
right.
a company that they bought in a certain space, and as we discussed earlier, a financial buyer wants to grow the business, improve the profitability, and yes, ultimately sell that, but they do that by making add-on acquisitions to what they call a platform company.
Right.
So they become a quasi-strategic buyer, and they will generally pay a premium compared to what I would call an unstrategic financial buyer, for lack of a better term. But a financial buyer in a certain space, which has experience in that space, owns a company or two in that space, may pay a premium if they see a company that they like in that space where they can get synergies and improve the performance of that target company.
Right. Right. So, I mean, I guess while we can make distinctions between the term strategic buyer and financial buyer, there are I guess, again, for lack of a better word, hybrid type of buyers that that their characteristics and their needs and their investment horizon all need to be taken into consideration, it seems to me, by the seller, because that's going to drive a lot of what the seller is going to get, both from a premium perspective, but also from as you had pointed out, a management, continuing in management, perhaps getting a second bite at the apple, all of those things. So the seller almost has to assess the strategic aims of the buyer, be they a strategic buyer, i.e. a corporate buyer, or a financial buyer. Am I getting that right?
Oh, you absolutely you touched on a key point or a key method of improving a valuation of a business. And that is really understanding the motivation of the buyer. If and let's a company on a standalone basis, let's say it's an industry and it's worth a 6 times EBITDA, a 6 times multiple. A buyer is going to look at that company and say they can do better. They may be able to close a warehouse, have greater efficiencies, greater economies of scale, better distribution, and they're buying this company because they feel that they can improve on that performance. So understanding their motivation is absolutely key.
Yeah. There's actually another thing that has been told to me by several people. I'd be interested to get your perspective on it. One of the things about particularly in the lower middle market, one of the challenges that are faced by sellers is that they don't really have a great concept of sort of wrapping up their internal stuff tightly. In other words, they're very good at producing what they produce, otherwise they wouldn't be successful, the services or the products they provide. But their internal processes, sometimes fall well short, and then that can kill a lot of deals, as I'm sure you know, because the buying company or the buying entity basically say, well, look, there's no way we can replicate this, or it will cost too much to fix the internal side. On the other hand, there's the concept of the buying entity saying, actually, it's a good thing that they've got some weaknesses because that gives us opportunity for increased value. And I guess that was kind of what you were referring to in terms of, maybe manufacturing efficiencies or distribution efficiencies or things like that. I mean, so to a certain extent, a seller can some of the seller's weaknesses can actually be an attractive thing to a buyer. Am I crazy on that?
I mean, the answer is it depends.
Yeah.
We're getting more and more involved with what we call pre-transaction planning, where we're trying to work with sellers to work on their deficiencies and improve them before they get a company ready to be sold. So, we will work with them and this way maximize the value. I think what you're saying is sometimes you will, and again, we will make this argument where we brought it in, the company has to be sold, there's no time to fix the problem, and we will present a case to the buyer and say, look, here is the upside potential. If you fix this, and this, you can take the company's earnings from this level to a much higher level. So I wouldn't call it, look, it's better to have done it yourself and to be properly prepared for a sale, but we often will present the upside case to a buyer and explain that with adequate capital, the company's performance can be materially improved, and that what that does, it moves the needle, so to speak, in terms of the potential valuation.
Right. And I'm thinking that would apply. It would apply to both, but it would probably more apply to a financial buyer. But yeah, I see your point. Yeah. Okay. So on a broader level, there's been a lot of stuff that's come out recently, a lot of information that's come out recently talking about the activity in the M&A market, and it seems to be much more positive. Obviously, there's been several years here where everyone says the wave is coming because of the dynamics of the marketplace. The baby boomer owners are itching to retire now, and low interest rates and lots of money on the sidelines, and a lot of private equity guys need to start spending money, or conversely checking out, right, because they need to close their funds. What do you see? I mean, in terms of, here we are in November of 2014, heading into 2015. How is the M&A market and the middle market? How's it looking? What's your sense of things?
Excellent question, and something we get asked often. And we have to take a look at from whose perspective. The buyers, both the strategics and, as you said, the financials, have a lot of cash to deploy. You read every day how the strategics have record levels of cash on their balance sheets right now that they need to employ. And similarly, you're absolutely right. The financial buyers have money in their funds, and the clock is ticking on these funds, and there hasn't been that much activity over the last couple of years. So this is a great time to be a seller. The sellers have been reluctant and have been cautious. They've wanted to wait till the economy's improved and their earnings have improved. So there's really been a mismatch where there really been more buyers out there than sellers. We are seeing now that with improved economic performance, improved confidence in the economy, we are definitely seeing a pickup in business, both in terms of what we would call pre-transaction planning, where we're working, advising on companies getting ready for sale, and in fact, our pipeline really hasn't been this strong in several years.
No, that's great. Yeah, I'm hearing similar things from interestingly disparate places in the sense that, I talk to folks like yourself, investment bankers, and I speak to private equity guys, but I also speak to the sort of the transaction-related guys, the due diligence folks, the accounting firms, and all those kind of guys. And it's particularly the latter group that I found to be very interesting because they've been telling me now for a few months that because they're sort of the bellwether, aren't they? Right? I mean, once you start doing due diligence, it doesn't mean your transaction's going to close, but it means that there's transactions out there. And they've been saying, for several months now that their business is really going gangbusters, which means there are going to be completed transactions sometime in the near future here, right? So it's
correct. I'd probably like to make 2 points on that. First point is that the level of due diligence that buyers are putting the sellers through is really much higher than it's been in the past. That's why, in fact, a lot of the due diligence people are so busy right now. While they are interested in buying companies, and the one thing we neglected to mention is the role of banks. With the banks lending aggressively again, that's also fueling the financial buyers and pricing on that side as well. So there's a lot of availability of cash. The buyers really want to buy. However, they've just been through 5 or 6 tough years, and they don't want to make mistakes. They don't want to repeat the same mistakes that were made prior to the financial crisis. Right. So they're doing more due diligence and they're really kicking the tires much more carefully. And I won't tell you what kind of medical exam that a lot of sellers compare this to, but you can just guess. I'm
already there, Michael. I'm already there.
And, they're a little surprised by that. And as a result, it's very important for sellers to be prepared for this level of due diligence.
Be sure to check back for future episodes of the President and CEO Focus on the Middle Market podcast series. Thanks for listening.